Hello, and welcome back again to Wall Street Training's Mergers and Acquisitions Deal Structuring course. In this segment here, we will look at common deal structuring issues. Let's talk about a stock versus an asset deal. A stock versus an asset deal. Let's say I have a company called XYZ Company. XYZ Company owns an asset. Let's say, hypothetically, XYZ owns a $100 podium that they purchased. Thus far, there has been $50 of accumulated depreciation on this asset. Therefore, the book value, the net fixed assets, is $50. These numbers will be important later on. Net fixed assets, or what we'll just call the current book value, is $50. Let's say the following happens. Let's say you come in and say, hey, I want to buy this podium. This podium, it's one of a kind and is no longer made. And I say to you, sure, I'll sell you this podium. And we agree to a purchase price of $200 for this podium. So let's write that down. We will sell this podium for $200. Now, let's talk about, from the legal perspective, the stock versus an asset deal. The legal perspective, you have an option. You can buy the stock of XYZ Company and own the entire company as well as the podium. Now, you can buy the podium outright from the company themselves. We'll put in parentheses, this is an asset deal. Now, think about this. We agreed to sell you the podium via the stock of the company. You will choose the left-hand column to buy the stock of XYZ, of which its only asset is this podium. It's yours. While we are in the process of closing, in other words, there was no undisclosed liabilities. Let's say we're in the middle of closing, and we put this podium in a hallway to be picked up for the delivery people, and somebody walks by, trips and falls, breaks their neck, ends up in a hospital, huge bill. In this wonderful society of ours, what is going to happen? They will sue. So now the question becomes, who will they sue? They, of course, will not sue the podium. They will sue the owner of the podium. Who now owns the podium? We have just closed the deal. The podium is owned by you. You own XYZ Company. That person will sue XYZ Company. You pay the liabilities. However, if right before the closing, this person tripped and fell, who are they going to sue now? They will still sue XYZ Company. But who owns XYZ Company while they tripped and fell before we closed? I do. I own XYZ Company because I did not sell you the stock, assuming I sold you the podium outright as an asset deal, which would be the right-hand side of our notepad. And therefore, when you look at it from that perspective, the liabilities will be borne by whoever owns the stock. So let's write that down. Underneath, by stock of the company, we will say the acquirer bears the liabilities because they own the company. On the right-hand side, we will say the seller bears the liabilities of the past. Now, you may ask yourself, well, let me be a little bit devil's advocate here. Liabilities, yes, good, I do know how to spell. Now, you may be saying, well, hey, the company, what are the chances of during that time period of the closing that somebody trips and falls on that podium? A realistic example might be a consumer product. For instance, let's take the drug Viagra. Viagra is produced and owned by Pfizer. Let's say their competitor Merck wants to come and buy Viagra. They have two options. They can buy the rights to Pfizer, the name, the marketing, the product itself, the patents, blah, 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 blah. Or if they chose to buy Pfizer, the entire company, they will also get Viagra. Let's stick to this. Let's say now, at some point, it is suddenly discovered that Viagra causes cancer. And it has a lot of additional side effects that were not anticipated. Now, who bears the liabilities? they are going to sue. They, as in the users of Viagra, are going to sue everybody. Let's say first that Merck acquired Viagra, the brand, as an asset, and the production and the products and the trademark and the patents, everything else. All of the people who used Viagra prior to that sale will sue Pfizer. Of course, they'll sue Merck, they'll sue everybody, but Pfizer will be the ones who will bear the liabilities of the asset in the past because they were the previous owners. Going forward, however, Merck will be responsible for that particular liability. Now, what if Merck bought all of Pfizer? If Merck bought all of Pfizer, because now they own the stock of that company, all of the previous liabilities that were previously undisclosed and unknown are now going to be borne by Merck. Hence, in a stock deal, the acquirer will bear the liabilities, and in an asset deal, the seller will bear the liabilities up until, of course, that purchase date. So let's add to our slide down here and say the following. The seller / the target prefers, obviously, which deal? The stock deal. Got it? Now, let's take a look from the tax perspective. We just talked about the legal. From the tax perspective, what is the purchase price of this asset? $200 is the price. You're going to buy it from me for $200. What is the current book value? $50. Therefore, what is the quote-unquote taxable gain? Obviously, $150. Let's assume taxes of 40%. 40% tax rate is a $60 hit. What is the net gain? $90. To that, you will add your net book value. And you, or me in this case, I will receive cash of $140. Now, if I'm going to receive cash of $140, let's say it another way. I receive $200, I pay $60 in taxes, and I get $140 cash, same number. Now what usually happens is, you have now acquired the only asset of this company. I no longer need this company as a shell company. Therefore, what will I do in most cases? I will dissolve the company. And I will then give myself a shareholder distribution of $40. And once I give that shareholder distribution of $40, what happens? I am now taxed. So, what is going to happen? That should be a shareholder distribution of $140, by the way. Now, I will say that I have, again, put into my company $100. That was the initial price of the podium I paid. My gain was $40. Why? Because I have a $50 gain. This will be a capital gain. On the individual level, I will now be taxed individually at that $40. This is what we will call potentially double taxation. And you can say to yourself, well, you know what if I don't dissolve the company? What if I don't pay myself a shareholder distribution? Fine. It's the same thing as paying yourself a dividend. No different. Current income. So, let's summarize that, what we just wrote. If I, XYZ company, I'm the shareholder of XYZ, sell you this podium as an asset, I get double taxed twice. Well, I get double taxed once. I get double taxed. The company gets taxed upon the gain on the asset, and then I, on the individual level, get taxed again. On a stock deal, that does not happen. Because you are buying the stock, I get only taxed on the personal level via capital gains. The corporation, the company itself, the entity, does not get taxed. So, let's go back to the left-hand column now.